Good evening, everyone. Welcome back to the channel. So I want to discuss today how dividends can be actually more important in a down market like the one we're seeing. And also, I want to go over some market coverage. And I forgot to start my screen share here. Let me get that going. But I want to go over some market coverage. And tomorrow is the big announcement on the Fed rate hike. So in anticipation of that, the markets were pretty much all down today, all the indexes. The Dow ended up down 313, NASDAQ down 110, Russell and S&P both down as well. And it seems like the consensus tomorrow is that we won't get a 1% rate hike, but that we may have something like a 0.75 or less, or probably 0.75. So what I want to go over, if you're losing between 20 and 25 to maybe even 30% in stocks, well, we talk a lot about dividends on this channel, and not just that, but dividends trend very popularly online in general. So what I want to look at, I want to take one of the top trending funds known as SCHD, the US Dividend Equity ETF by Schwab, which is paying a 3.35% yield, which isn't the highest you can find, but it's not the lowest either. But if you take the year-to-date total return, which is only negative 10.46%, if the fund didn't pay a dividend out, then you would absorb that whole decline in the value of the fund. But because you're getting a dividend, you're getting like a guaranteed positive return of 3.35%. And let's look at historical data just to see how long the dividend has maintained itself. Because the good thing about a lot of these funds is that even in a recession, the dividends hold steady. So let's go maximum here. And I believe this one, because I've done a couple more videos on this in the past. Let's see. This is a pretty good. So June was the last dividend that's showing. Oh, quarterly. That's right. It's a quarterly dividend. But it looks like going all the way back to 2011, it hasn't missed any dividends. So you want to find stuff like that, like the SCHD, Schwab US Dividend Equity ETF. Because, like I say, if the market's going to drop, at the very least, you have the dividend. And if you're reinvesting that, you can reinvest it into the stock or the fund at a lower price if the market's dropping. So, and that goes for ETFs and stocks as well. But, the thing is, like in a prior video I did probably 6 months ago now, I referenced an article showing how 75% of the returns of the S&P 500 were actually came from dividends from like 1980 something to 2019. So reinvested dividends can end up being a big chunk of your return. And especially, like I continue to reiterate, in a down market, it's probably more important to be in dividends. And with that being said, I'm going to look into some others here. I found this site called suredividend.com. And it says, let's see, high yield stocks can be very helpful to shore up income after retirement. A $120,000 investment in stocks with an average dividend yield of 5% creates an average of $500 a month in dividends. Sounds like what we talk about a lot on this channel, like my spreadsheet here that I've used for several different videos. This is actually, let me see, I think this is the one that I did. Oh, that was SP or SHPD or whatever it was. Yeah, I showed my monthly dividends for August. I'll do another video at the end of this month updating my September dividends. But, just looking at like a JEPQ, probably the most popular trending dividend ETF right now, if you just keep reinvesting that 15.89%, and again, that's a covered call ETF, but, that compound effect is going to accelerate your gains very quickly, as you can see here. And then just assuming an average 8% yield, which stocks like AT&T paid close to an 8% yield at one point. But you can see how, $800 in the first year, and you can see the compounding from there at a compounded 8% reinvested annually. Let's look here to see, because this actually had stocks. I don't talk as much about dividend stocks, but the first one here, this MPLX, this I believe is a limited partnership. So this is an 8.7% dividend yield. It's a master limited partnership formed by Marathon Petroleum Corporation in 2012, operating in logistics and storage. Yeah, these tend to not do that well from an overall investment standpoint, but they typically pay out a sustainable, steady dividend. So that was number one on that list. And when you go to lists like these, typically these aren't like your best performing stocks, but they just so happen to pay the highest percent dividend yield at that point. Altria Group, ticker symbol MO. I've heard of this one before. Founded by Philip Morris in 1847. Wow, so that's been around quite a while. Smokable product segment, Marlboro. Yeah, some of these, like Philip Morris, pays a good dividend too, but this is an 8.4% dividend payout. Dividend score B, risk score. Marlboro is their flagship brand. I wonder if we can discuss this on YouTube. It's just cigarettes, but anyway, that's what they do. Not advocating or disadvocating, but 40%. That's Marlboro is 40% of the retail market. So they pay a pretty good dividend. Here's their valuations here: current price, fair value price, actually showing them slightly undervalued. 5-year CAGR estimate, market cap. Okay, let's look at the next one real quick. Sunoco, this is another energy play. 8.3% dividend yield, also MLP, Master Limited Partnership. And yeah, that's not bad. I mean, if you can get an 8% guaranteed return in the form of a dividend, it's pretty good. So, and then let's just look here at the next one. Magellan Midstream's Limited Partnership. This is probably another energy play. This is a C for dividend risk score, 8.1% dividend yield, 65% of total operating income, transportation and storage of crude oil. So that's probably a good play for this year. City Office REIT. REITs are also tremendous when it comes to dividends, and there's some REITs that actually pay higher than this. This is dividend risk score of a C. Let me see in my notes here if I had some other REITs. I haven't actually talked about REITs on this channel, but let's see. No, I guess I didn't write them down or type them. Interesting. Oh well. But yeah, I'll do another video on that. The top paying REIT dividend yields. So this is City Office REIT, internally managed real estate investment trust focused on owning, operating, and acquiring high quality office properties located in 18-hour cities. Interesting. So that's 7%. Hanes Brands. This is the underwear company, 7% dividend yield, and that's probably pretty sustainable, pretty much recession proof. And then Western Union, number 7, 6.7%. They've been around, it seems like, forever. So those are some probably pretty stable dividend plays. Let's check and see here. Top REIT dividends. Yeah, see, some of these are crazy. And this is the same website here, Share Dividend. Not sponsored by them or advocating them, just happened to find it. Let's see. Armour Residential REIT. This could probably be a separate video, so I'll just look at one here, and then I may actually do another video on this later on. 16.7% dividend yield. That's phenomenal. But the thing is, what happens with these REITs, what tends to happen, because I know I have relatives in REITs, and what tends to happen is that if the business model that's sustained them for so many years starts to decline and the company starts to lose money, well, the company's guaranteed you that dividend payout. So that dividend payout can end up cannibalizing the balance sheet of that company. And I've seen that happen. So the worst case scenario, say you have like 100,000 in a REIT or 50,000, say that REIT drops by 50%. Ideally, that high dividend should at least replace the capital you put into it. But you don't really invest just to replace your capital and only get your capital that you put in out of it. You invest to make a positive return. So those high dividend yield REITs, while they look attractive on paper, got to be cautious. So with that being said, we will see what the result that Papa Powell is going to come out with tomorrow in terms of his decision on the interest rate hike. Most signs point to 75 basis point or 0.75% hike, 0.75%. So we will see what that does to the market. It was down 313 today from the Dow. We don't have any futures yet. We should by now, but let's check real quick. Let's check if futures are trading. No, let's see, Dow futures, and then we'll end the video. Let's see, I like CNBC better than CNN. Let's see. Okay, futures are down 10, so no major movements, but we'll see what happens. We'll see 1% at this point would be a big surprise, but most of the consensus is that it's going to be a 75 basis point hike. With all that being said, thanks so much for watching. Please remember to like, comment, and subscribe. Take care, and keep an eye out for the next videos.